So you're intrigued with the returns and the money that you can make as a private lender, but you don't want to lose money, or you're a real estate investor that's actively looking to raise private money to grow your real estate business, but you want to raise money the right way and set everybody up to win, then this video is definitely for you. My name is Dave Perichin, and for over 14 years, I have been working with private lenders to buy houses and fix houses, to either refinance to make a rental property and build a portfolio of rentals, and or buy houses, fix them up, and resell them for a profit. And I've made a ton of mistakes in building a successful real estate portfolio and real estate business, but I'm happy to say that through the years, no matter what happens with deals, I've always paid my private lenders back, and I'm here to let you know, private lenders are the lifeblood of this thing. If you're going to pay anyone back, you got to pay your private lenders back. And there's several private lenders that I work with very closely that have lost millions of dollars with other operators, with other fund managers, and with other real estate opportunities that they got involved with. In this video, I'm going to be sharing with you some of these mistakes that have been made. This way you can avoid these mistakes. You can be successful raising private money for your real estate business, or be successful being a private lender. You can make a lot of money and do this thing the right way. So first and foremost, as a private lender, I'm going to encourage you that you just keep it simple. We're going back to that principle, KISS, keep it super simple. And the way that you're able to do that with private lending is by sticking to the most simple and the most liquid asset class. And that, my friends, is single-family houses. The reason single-family houses are going to be the best place to do private lending, or in my opinion, really the best place to operate a real estate investment company, is they're the most liquid, there's the most exit strategies, right? If something was to go wrong with a single-family house, there's the most amount of uses for a single-family house. You can sell it. There's the most amount of buyers for a single-family house rather than an apartment building. There's a very select amount of buyers for a big building or like a commercial space or something like that. When it comes to a single-family house, there's the most amount of users or buyers, the most amount of people that want to buy a single-family house that they can live in with their family, or you have a massive investor pool. There's people that will buy this single-family house to make an investment property for themselves, but there's the most amount of buyers, and that's what makes it the most liquid. Also, if something was to go sideways with a single-family investment, you could always rent it out as well. You can't do that if you're investing in shopping centers or land or something like that. So keeping it simple means investing with single-family houses because there's the most amount of exit strategies, the most amount of users, and the most ways to actually monetize this thing and make money and get it performing. Another reason I think sticking with single-family houses is going to be very important and set you up for success is it's the easiest to analyze. So if you're a private lender or you're looking at private lending, you want to be dealing with an asset class that you understand. And really, this is with any type of investing. I don't care if you're buying stocks. That's what they say. You got to know what you're buying, right? Well, with single-family houses, it's the easiest to analyze. And I'll give you a quick example. Let's pretend a real estate investor brings you a lending opportunity and they say, hey, I feel this house is worth, 190, 200, and I'm only looking to borrow 120,000 on this asset that's worth 190 or 200. It sounds pretty good. You're only putting out potentially 120,000 secured against an asset that they're telling you is worth 190 or 200,000. That's a good loan to value, and I cover loan to value in depth in other videos, but you get the idea for this example. So let's pretend they're telling you it's worth 190 or 200. You want to verify that. As a smart private lender, you want to really verify the value because that asset that you're lending on is the collateral for your money and for this loan. Well, single family houses are the easiest to analyze. It's the easiest to just get a snapshot and an overview of what the value is. If this investor is bringing you this opportunity, you can pull it up on Zillow, you can look at it on Realtor.com, Trulia. There's any number of sites and methods here to just get a general idea of the value. Are these sites perfect? No, it's not perfect, but you don't need perfect. You just need a general idea of what this thing is worth. You can do due diligence and get deeper into MLS comps and looking at comparative market analysis and things like that. But just actually looking at this as, is it an opportunity that you might be interested in? It's very easy to get a general idea of what a single family house is worth. So if this investor is bringing it to you and they say it's worth 200 and you look online and everything just online is telling you it's only 120, yeah, you're going to be a little skeptical of that particular opportunity. But if they're telling you it's worth 190 to 200, you pull it up online and everything that you see is also verifying 200, now you're at least interested enough to take the next step and do more due diligence. So keeping it simple means sticking to single family houses for the simple reason is, number one, there's the most amount of exit strategies and the most amount of opportunities to monetize this asset. And also, it's the easiest to analyze. You can just pull up valuations online very easily. In contrast, or the contrary, is like a large apartment building or a large syndication that you could potentially invest in. It's kind of tough to know. I mean, you could look at the spreadsheets and look at this presentation and it all sounds good, but it's much more difficult to really understand the ROI potential, understand cash flow and things like that when looking at investing in maybe a business or an apartment building or some type of commercial or more complex type of asset. Single family is by far and wide the simplest, and I believe you should stick to single family. If you're new to private lending or if you're raising private money, it's very easy to raise money with single family assets. Number two is I'm going to encourage that you avoid big rehab projects, avoid big construction. And I used to say in these videos, you know, unless you're very experienced with large construction projects, you should avoid them. I am personally experienced with large construction projects, and I'm even staying away from large rehabs in large construction simply because it is not the most efficient way to move forward. It takes a lot of time to fix these things, and it's a lot of risk. So let's look at this from the eyes of the lender. If you're lending on a piece of real estate, and let's say this investor brings it to you, they're buying it for 80 and they need 40 to fix it up. Well, a lot could happen to that $40,000 in construction money. Managing construction, in my opinion, as a true real estate operator, is probably the most difficult thing. You're dealing with people, you're dealing with contractors, that contractors could be very dangerous, right? They can steal your money. I personally was awarded a judgment of $174,000 that I lost to a contractor that ran out on us, right? It could be dangerous with large amount of construction, and when you're dealing with large rehab projects, it adds risk to this scenario. So me personally, I'm only taking on single family houses that don't need a huge rehab or a huge construction budget. So if you're looking to lend on something, your red flag should go up. Your spidey senses should increase the larger the rehab is, because there's a lot of room for error and there's contractors that can steal money. Believe me, I've dealt with this before. So it's gonna be easier for you and the operator to just stick to properties that don't need a gigantic construction. We're not taking on anything with foundation issues, water in the basement. We're not taking on even concrete work. We'll do the basics, you know, roofs and HVAC and things like that. That's really the extent, and obviously normal remodels and paint and carpet and flooring and kitchens and bath. That's normal, right? But I'm not taking on additions. I'm not looking to build extra structures on a lot or anything like that. So if you're considering lending, I would be careful of anything that is not just a run-of-the-mill type of rehab. That's going to keep you the safest. Also, one more thing, if you're lending on a project that does require a large amount of rehab capital, so if you're making this loan and it's kind of a sizable amount of money, I would say over 40, 50,000, you as the lender may consider releasing this money to your borrower in the form of draws. So let's pretend the property needs $50,000 in rehab or construction. You may release at the closing, you're going to fund the purchase of this asset, but maybe you only release 1/3 of the construction cost. And this is enough to get the operator started, and then the operator can then send in update videos and pictures. And once you feel comfortable with the work that's been done so far, you'll release that second half, and then finally the third portion of the rehab construction money. Remember, you as a lender could only lose what you put out, right? That's with any investment. So you may consider, if this is a new relationship with you, or if it's kind of a sizable rehab, I would say anything around $50,000 or more, you may consider breaking that money up into draws, and so you're not funding the entire rehab up front at the closing. Now, for me, with my private lenders, I have amazing relationships, and I'm not taking on private or large construction projects, so I'm able to really get the rehab money up front. And simply because a lot of the rehabs we do, 10, 20,000, it doesn't really make sense to break it into small draws. It's kind of, overkill at that point. But if it's a large construction project, you may consider releasing the money in draws. Next up, I want to talk about title and security. So every real estate transaction that you get involved in as a private lender, you should make sure this is being closed at an intermediary, like a title company or a closing attorney. So never, and this is a huge thing, never send your money, never wire money to the operator directly. Never wire money to some bank account. They give you a PDF file that's got some numbers on it. Oh, I'm just going to send this money out. That is a huge risk right there. You need to make sure that this transaction is closing at a bona fide closing agent, like a title company, and do your due diligence. Speak to the closing agent on the phone, get all their information, make sure they send you the wiring information where you're going to be wiring this money for this private loan in some type of encrypted fashion, right? Make sure it's a secure type of email. But then finally, take the next step and call your banker and verify the routing number and verify the account number. It's just a phone call. Make sure that banker is able to see that the name on this bank account, they'll verify it for you. Any business banker will do this. They'll verify that this account number does indeed belong to the title company that you're doing business with. There's a lot of fraud out there, everybody. So just take that extra step and verify that this transaction, of course, is closing at a title agent or some type of intermediary, right, that is bona fide and reputable, and then make sure the account numbers and the routing numbers match up so you're sending money where it's supposed to go. Next up, when it comes to the security for your loan, we are talking about lien position. So when you lend this money as a private lender, your money is secured against the collateral. You have a lien against the property that's being purchased. So liens work in positions. There's a first position lien, and then any liens below that first position or behind that would be considered a second lien or a third lien. For instance, a first mortgage has all the seniority and all the priority. If it came down to getting this property back or you had to take the property back, the first lien holder, the first mortgage, has all the seniority here. So I'm going to encourage that you never do second liens. Never invest. I know people who have lost millions of dollars lending money, but their money was secured or in second position behind a first mortgage. When this operator who was borrowing money in second position, when they ran into trouble, The first lien holder had all the security. They were able to take the property back, sell it, and recoup their money. Any money that's left over, which there likely is not going to be any money left over after the first mortgage holder takes what's theirs, and then all the attorneys involved, and it's just a big mess, right? There's not going to be anything left for the second lien holder. I'm going to encourage that you just stay away from lending in second position. Always make sure any private loan that you do is always in the first senior lien position, and there shouldn't be any liens behind it. You know, we personally, in our real estate business, we don't borrow seconds. I've never done a second mortgage once. We work with one lender, one borrower, one asset, which is typically a single family house or maybe a small apartment that's very easy to underwrite. Everybody's on the same page. None of this second position stuff. Make sure you're always in first position. And the last part when it comes to security is insurance. If you're lending on this property, you need to make sure that your borrower is putting adequate insurance in place, right? And the way to do that is just request that your borrower actually adds you as additionally insured on the insurance policy. Now you're additionally insured, meaning if something happens to this borrower and then something happens to the asset, the insurance company is going to cut you the check. You're on the policy, right? There's no risk for you at all to be added to this policy. You should be on the policy, and that's also going to give you a clear snapshot of the type of insurance that's against this property. You can even have a conversation with the insurance agent. But you as this lender, you need to make sure the property has insurance, number one, but also make sure you're added onto the policy as additionally insured. Now, finally, and this part might be a little controversial, but this is very important. When you're wanting to be a private lender, when you're doing private lending, it is so much better and so much more secure to invest with a single operator rather than investing in some type of fund or some type of syndication. Let me just kind of explain the difference. When you're lending to a single operator that you're the only lender, you're in first position, you're the only lender involved here, there's only one borrower, and it's a very easy communication there. One lender, one borrower, one asset, and that's it. And that's the collateral. You've done your due diligence. You know you're lending 120 on a house that's worth 200. It's a pretty straightforward deal. When you're investing in a fund or a syndication, that's where this operator is actually borrowing 120 from you, 120 from 10 other people, pooling this money together. That's what a fund is. That's what this is known as, a fund or a syndication. They're pooling money from multiple parties together to go buy an asset. And normally it's a large asset like an apartment building or something like that. So they're borrowing smaller amounts of money from multiple people, pooling this money together to go buy an asset. Well, I'm here to let you know what happens if that fund goes bad. What happens if the asset that they're buying by pooling everybody's money together actually goes sideways? Who gets paid back first? It's very difficult to get your money out of these funds. And I'm not here to let you know or say all fund managers are bad. That is not what I'm saying whatsoever. I'm just letting you know from a control standpoint, if you want to be in control, it is so much more beneficial for you to just lend, not in a pool of money, but just to one single operator with one single piece of collateral. Because you got to imagine, if you're in this fund with all these other people, how is the collateral divvied up if this thing needs to get foreclosed on? It's just a big mess. And then also, when it comes to these fund managers, I just got to tell you, the way these funds are written, it's literally, you know, they create what is called like a PPM, a private placement memorandum, and they register with the SEC. It's like a big deal, right? But they write these funds and write these offerings and write this paperwork to completely protect the fund manager. So if something happens to this asset, really a lot of these fund managers, they could just walk away scot-free. And they could just say, hey, you guys deal with it, and now you're kind of fighting with everybody else who's in this fund. Everybody wants their money back. But these fund managers, not all of them, but I'm just letting you know, they don't have skin in the game. A lot of them are just hiding behind a computer. They don't even walk through the property or the assets that they're buying. and they're really good at raising money from all these different people, but you know, they don't care if the project goes belly up. They have nothing to lose in these situations. And unfortunately, that's how it works with a lot of these funds. And they're collecting fees. They're paying themselves a salary out of the money typically. Not everybody, but please fill me out here. Typically, these fund managers are making a salary from the money they raise. They're earning fees from the money that they raise. So even if this investment goes belly up, the fund manager has nothing to lose. They made money the whole time, and the only person that lost money is you, and you have no control because there's all these other people involved, attorneys involved. It could be messy. So I'm going to suggest you work with real operators like us over here and like these other real estate investors out there raising money on one single asset. It keeps you in control. You don't have to fight with anybody else to get your money out if things go sideways. And that's just going to put you in a better position. There's more security when you're dealing with a single operator. So I hope you enjoyed some of these bullet points that I'm giving you, some of these red flags and some of these landmines within private lending for you to avoid. Or if you're a real estate investor and you're out there raising private money for yourself, use this information to educate people. Let them know that you're one of the good ones, right? You're raising money against strong assets that are easy to analyze. You're not taking on big rehabs. Your lenders are in first position. When you are able to educate the market and educate potential lenders with all this information that I'm giving you in these videos, you're going to put yourself in a strong position. The lender's going to feel good, which they should. If you're doing it the way that we're talking about doing it, everybody could win together. And if you're a real estate investor, you're looking to scale your real estate business, or you just want to be in a relationship with us, consider joining our school community. The link is down below. And we cover everything from wholesaling to novations to raising private money. Really, those are the big three things that we do a lot of. So we do a ton of videos. You can see on the channel here, a lot of videos about wholesaling and novations. And we also JV with members in our school community. So if you're out there finding deals and you would like our assistance and you want to partner up on some deals, joint ventures, we do that quite a bit with school community members. Or if you're a private lender and you're interested in learning more about how we work with private lenders, I would consider jumping in the school community as well. You can get to know us a lot better, and we'd love the opportunity to have that conversation. So on behalf of the cream, we appreciate you being here. Make sure you do all the things, hit the like and the subscribe and hit that bell for notifications. So every time you pull up YouTube, you get a little notification there that we uploaded a new video. We upload new videos weekly. And hey, let's all win together. What happens with the cream? The cream always rises to the top. I'm Dave Perichin. I look forward to seeing you on the next video.